Anup Singh, Director of the IMF Asia Pacific, joins us on the show right now to give a quick perspective of the macro picture across the globe. Mr. Singh, thanks very much for speaking with us. To start with, could you take us through the IMF's outlook for emerging economies in Asia, especially in the light of the recent developments in the Eurozone? Could you also outline what are the key risks to growth for these economies from IMF's point of view?
Well, the first thing I'd say is that emerging Asia is growing really quite soundly, given that advanced economies are growing much less. We project emerging Asia to grow around 7% this year, rising to 7.5% for next year. And China is at 8.2, rising to 8.75, and India is close to 7. We believe even that, if things stabilize externally, that could rise up to 7.3%. Now, clearly, as you said, there are risks. Most of the risks come from external markets. They come from advanced economies, since Asia and India are dependent on advanced economies in the US and Europe on both the trade and the financial side. So there could be risks coming from there if there were any downside shocks. There are clearly also risks from commodity prices, from oil prices, and there are risks also from capital flows. But overall, the point I would make is that domestic demand in many countries in Asia, including India, remains fairly strong, and that is why we see growth around 7%, close to 7% in India and in emerging Asia.
Right now, Mr. Singh, a lot has been said about the policy paralysis and the lack of initiative on the part of the Indian government in terms of economic reforms, or even returning to a path of credible fiscal consolidation. Surely the IMF's growth projection takes into account all of these issues. How much of an impact could these issues really have on India's growth prospects?
Well, we project growth remaining close to 7% in India under current policies. Now, what you are talking about, where things are, the reason is that in India, investment has come down from where it was a few years ago. The investment rate in India reached close to 38% a few years ago. It's now down to 35%. It's partly because corporate investment has fallen, and that is why we have growth at 7% and not where it was at 9%. Having said that, I think it is well recognized that if investment can be restored to where it was through infrastructure investment, this would catalyze and drive private investment back up, and therefore there's clearly the potential for India to go back to where it was if conditions improve for investment, but it's also dependent a lot on external factors.
Last year, emerging economies, especially India, experienced very volatile capital flows, and a lot of capital fled Indian markets as global risk aversion grew. What's your sense on capital flows returning to emerging markets like India this year?
Well, I think the capital flows volatility will continue. What is important to note is that in the first quarter of this year, capital was coming back into Asia, including India. In fact, in the first quarter of this year, you saw capitals coming into equity and bonds in India. The challenge that India and Asian economies face over the medium term is to ensure that more of this capital flows comes in the form of FDI, foreign direct investment, and it goes into sectors such as infrastructure, but also other sectors that are important for building the sustainable growth that India and other Asian economies are targeting over the medium term.
And finally, Mr. Singh, in a recent report, the IMF has said that central banks around the world need to return to policies that are more in line with normal situations. What's your view on the RBI stance, given it's in a unique situation where it needs to take care of the growth inflation dynamics in the country?
It's an important balance. I would make 2 points. The first is, if conditions stabilize in external markets, you can be sure that overheating pressures will rebuild in many countries in Asia. And given that macro policies in many countries are quite accommodative compared to where they were a few years ago, we are possibly close to a situation where macro policies, interest rate, fiscal policies need to become less accommodative and closer to where they were a few years ago. However, until we are in that state, It's important to balance this with the real economy. And therefore, when you see how we strike the threshold between inflation and growth, but the Reserve Bank of India and other central banks have made it clear that they want to bring inflation back to their target ranges.